There's a growing consensus among market observers that benchmark rates in the US will likely remain steady after the Federal Reserve's 10th hike this month. But on what comes after that, the views are somewhat mixed.
I think the Federal Reserve, after the series of rate hikes they've done since last year, will take a step backwards to assess the impact that the rate hikes have had on the economy. And if inflation does not seem to abate further from here, then they're likely to actually hike further.
Our central scenario is that the next move is going to be a cut, not as fast as the market is anticipating, but probably in Q4 of this year. The signs of recession will become so obvious that even the Fed that's worried about inflation will have to reverse course.
A robust labour market and consumer inflation that's twice the US Fed's target make the case for another hike. But the ongoing debt ceiling debate and weakness in regional banks point to a potential rate cut.
We have an 80% probability of a recession in the next 12 months. That's the highest we've had for a long time. And so we're looking for 50 basis points of rate cuts in this year. But that's not the end of the rate cutting cycle. We think the economic environment will turn pretty ugly at some point. And that will lead the Fed to cut rates into the beginning of 2024 as well.
The end of a rate hike cycle is typically bad for equities, but good for fixed income.
If you're looking at the US 10-year Treasury yield, they can come down by maybe 50 to 75 basis points. At least it should help you generate single-digit, mid to high single-digit returns. On the equity market side, in the developed markets, we think we could get a significant leg lower, so maybe 15-20% before we form a base.
Already, investors have been flocking to fixed income mutual funds to take advantage of attractive returns.
The average US dollar money market fund is yielding anywhere between 4.8 to 5.1% right now. It's daily liquidity, T+1, and most of the funds are government guaranteed as well. So there is really no reason for you to be in a fixed deposit if that's the case. Because even if it's a fixed deposit and you are pushing 5%, you're likely to be locked in for 1 year.
Bonds are debts issued by companies or government entities. When investors buy into bonds, they are essentially lending money and earning from interest payments and capital appreciation when the bonds are fully redeemed. Bonds vary depending on their coupon payment, maturity, and whether or not they can be converted into shares. Government and corporate bonds are typically issued through brokerages, but there are ways for retail investors in Singapore to get bond exposure.
Investors can kind of DIY themselves. They can trade and buy off the SGX for easier access. The retail bonds are at a lower quantum. Corporate bonds typically have a much higher minimum quantum, which they require maybe about 250,000 per whole lot, as compared to retail bonds. More common will be Singapore T-bills, the treasury bills. Yeah, so the minimum lot is usually about SGD $1,000. So most retail investors shouldn't have much issues accessing them.
Corporate bonds issued by Singapore's 3 local lenders and treasury bills issued by the government are among those considered stable.
It attracts those who are looking for stability in their portfolio, probably for retirement purpose or probably for endowment purposes, so they know they can sustain this growth rather than taking certain risks in the unknown like equities.
A recent study by online wealth management platform Saif found that Singapore investors are leaning more towards safer assets like global bonds, Singapore savings bonds, and T-bills. To cater to this market, Saif partnered with asset manager PIMCO to offer fixed income portfolios.
We now have the suite of almost these kind of yield-bearing products, everything from 3.7% up to 8%. You should ask what is your kind of desire of return, what are you comfortable with, and then match it up with obviously your risk appetite.
While bonds are relatively safer compared to equities, there are also risks.
If it's over a very, very long duration, then you can be subject to very strong interest rate cycles. So it comes down to duration, it comes down to default risk, and I think the last, of course, interest rate, right? Interest rates go up, you will expect a correction in prices, which is what we've seen in the past. But with interest rates kind of stabilizing and expectation of decrease, you would actually start seeing the prices of the underlyings go up, which make it very attractive in this point in time.
We do prefer, mostly in the shorter to mid-term views, we currently prefer the investment grade. So investors may want to be as safe as possible because you're not exactly sure how the recession might be affecting most companies and the number of companies defaulting on their bonds.
Whether the US Fed takes a pause or makes a small increment in rates, experts say it will likely be a non-event for ordinary investors, and their focus should just be on rebalancing their portfolios.
Maintaining diversification is important with an overweight to bonds and also to gold is the way we're positioned. So we have around a 9 to 10% underweight in equities at the moment. So if your core allocation would normally be 40%, then maybe you should be around 30% at the moment until we see the bottoming in equity markets.
You can get a very decent portfolio yielding about 5.5% and very well diversified as well with US investment grade, Asian investment grade. Throw in a few select names where Asian high yield are concerned, and you can have a very nice high yielding portfolio that will basically generate you a decent income of about 5 to 5.5% over the next 3 to 5 years.